How to avoid losing money as a beginner trader. Basics of stock market trading. Before you dive into trading, it is important to understand how you can protect yourself from losing money. Stay until the end, because this could be a golden egg for beginner traders. I'll break down 8 rules to avoid losing money as a beginner when trading in the stock market, explaining each one of them and sharing those that I have learned and tested over the years in my trading career. Now let's dive in. eToro says that 80% of day traders lose money over a year. According to the US Securities and Exchange Commission, 70% of forex traders lose money every quarter on average. According to an academic study of day traders in Taiwan, the combined overall performance of day traders is negative. The vast majority of day traders are unprofitable, and many traders persist in trading for years despite their losses. It is estimated that 80% of day traders quit within the first 2 years, and nearly 40% quit within 1 month. After 3 years, only 13% remain, and after 5 years, only 7% remain. The average individual investor underperforms the market by 1.5% per year, while active day traders underperform by 6.5% annually. But there are some skilled traders who consistently do well over a long period of time. It isn't just a matter of luck. The biggest reason most day traders fail is that they really aren't traders, they are gamblers. Day trading largely attracts individuals with a gambling mindset. It usually takes a couple of minutes to click, buy, or sell, and open a trade position. Trading is a complex process. To trade well, a person has to invest time and effort. Not everyone is ready to pay attention and work for the result. Trading strategies require discipline and accuracy. Many people lack those qualities. Even though they have the best intentions, they either forget to act systematically or are too lazy to do that. There are no guarantees. It's often hard to accept the kind of uncertainty in the market. Traders can be reckless. They may forego market analysis, dodge setting stop-loss orders, and the risk management rules. All of this leads to mistakes and bad trades. So, how can you avoid losing money, as a beginner, while trading the stock market? There's a lot to cover, so stay tuned because, in a moment, I will give you a golden egg for beginner traders. If you find this content valuable, please hit the like button. It costs nothing but helps our channel tremendously. Now let's dive in. The first rule is to accept you will have losing trades. If you want to become a successful trader, you must accept that some losses are inevitable, especially in the beginning. Acceptance that you will lose is the first and crucial step. Only if you know your enemy can you fight it and win. If you are aware of risks, you will be more prudent and make better decisions. It's necessary to understand that a loss in a trade isn't the biggest problem. If you are careful about your trading volume and don't spend your entire deposit on a single transaction, you'll have plenty of money left in your account even after a bad trade. As a result, you'll have more opportunities to open better trades. However, if you are impatient and too eager to multiply your funds fast, a single losing trade may wipe your deposit. After you accept that you will have losing trades, as a beginner, in the stock market, it is very important to answer another question: how much money should I use as a beginner to start trading in the stock market? The question is important, because, if you trade with more money, you will definitely lose more, but if you trade with less money, you will lose less. And, the answer I am sure will surprise you. Because, it's $0. You heard me right. As a beginner, you must start with no money in order to avoid losing money while trading in the stock market. This brings us to the second rule. The second rule to avoid losing money while trading as a beginner is to start trading with zero money. And, you might be asking, now, but how can I trade with no money? And the answer is, paper trading. Paper trading is a simulated trading process where investors practice buying and selling financial instruments, such as stocks, options, or cryptocurrencies, without using real money. It allows traders to test their strategies, learn how the market works, and build confidence without the risk of losing actual funds. There are many brokers out there that allows you to create a demo account, for you to test your trading abilities before you even put your real money on the line. Key features of paper trading include real-time market data. Paper trading platforms use real-time market data to mimic actual market conditions, allowing users to experience what it's like to trade in real-world scenarios. Risk-free environment. Since no real money is involved, traders can experiment with different strategies without financial risk. Learning tool. It's an excellent way for beginners to understand trading mechanics, test technical analysis, and familiarize themselves with trading platforms. Strategy testing. Experienced traders also use paper trading to refine their strategies or test new ones before committing to real capital. Overall, paper trading is an essential tool for both novice and seasoned traders to practice and hone their trading skills. The third rule to avoid losing money as a beginner trader is to avoid the news. Avoiding the news as a trader can be a strategic decision, especially for those who focus on technical analysis or have a long-term approach. Here are some reasons why a trader might choose to avoid the news. 1. Emotional bias and noise. News often generates emotional reactions, such as fear or greed, which can cloud judgment and lead to impulsive decisions. Headlines can be sensationalized, making it easy to react irrationally rather than sticking to a well-defined trading plan. 2. Short-term volatility. News can cause sudden price swings that don't necessarily reflect the underlying value of an asset. Traders who focus on short-term news-driven movements might get caught in volatility traps, leading to losses. 3. Information overload. There's a constant flow of information, much of which is irrelevant to specific trading strategies. This can lead to analysis paralysis, where traders become overwhelmed and unable to make clear decisions. 4. Misinformation and market manipulation. Not all news is accurate or unbiased. False information, rumors, or manipulated news can mislead traders, causing them to make poor trading choices based on inaccurate data. 5. Overtrading. Reacting to every news event can lead to overtrading, where traders make too many trades in a short period, often resulting in higher transaction costs and lower profitability. 6. Focus on the strategy. Many successful traders, especially technical traders, rely on charts, patterns, and data rather than news. Sticking to a strategy and avoiding distractions can lead to more consistent results. 7. Delayed reaction. By the time news reaches the public, professional traders and algorithms have often already acted on the information, making it hard for individual traders to capitalize on news-driven moves. While staying informed is important, many traders find it more effective to focus on their strategy, technical analysis, or long-term trends rather than reacting to every news update. The fourth rule to avoid losing money as a beginner trader is to respect the trend. Trend trading is often more favorable than counter-trend trading because a trend serves as a filter, helping to weed out poor trade setups. Aligning your trades with the market's direction increases the likelihood of success. Buying during an uptrend and selling during a downtrend typically yield better results. Essentially, you enhance your chances of profiting by trading with the trend, making the most of the opportunities the market provides. The fifth rule to avoid losing money as a beginner trader is to always have a profit edge. You have complete control over your risks, making it essential to leverage this advantage. In every trade, you can set your preferred risk-reward ratio. The ideal approach is to ensure that your take-profit target is always greater than your stop loss. For example, if your stop loss is set at 20 points, your take profit should be set at 60 points. By following this rule, each winning trade will earn you 3 times the amount of a losing trade. With a trading strategy that delivers at least 50% successful trades, you can position yourself for long-term profitability. A profit zone must be long-term, meaning over 3 months period, because it does not matter if you will 100% of the trades in 1 month, then lose everything in the next 2 months. Which brings us to the next rule. The sixth rule to avoid losing money as a beginner trader is to backtest your strategy. Backtesting a trading strategy is crucial because it allows traders to evaluate how a strategy would have performed in the past using historical data. This process helps identify the strengths and weaknesses of a strategy before committing real capital. Here's why backtesting is important. 1. Validation of strategy. Backtesting helps determine whether a strategy is profitable under past market conditions. If a strategy performs well historically, it gives confidence that it may work in the future, although past performance does not guarantee future results. 2. Risk assessment. By analyzing how a strategy performed during different market conditions, such as bull, bear, and sideways markets, traders can understand the potential risks and drawdowns associated with the strategy. 3. Performance metrics. Backtesting provides key performance metrics such as win rate, risk-to-reward ratio, drawdown, and volatility. These metrics help traders fine-tune their strategy and set realistic expectations. 4. Improvement and optimization. Traders can identify which parts of a strategy work well and which don't. Backtesting allows for optimization by adjusting parameters, such as stop-loss levels and entry or exit points, to improve performance without risking real money. 5. Emotional discipline. Knowing that a strategy has been tested and validated reduces emotional decision-making during live trading. This discipline helps traders stick to their plans, even during losing streaks. 6. Avoidance of overfitting. A properly conducted backtest can help identify whether a strategy is too closely tailored to past data, overfitting. By testing the strategy on out-of-sample data, traders can ensure it's robust and not just a product of historical quirks. 7. Understanding market dynamics. Backtesting helps traders understand how their strategy responds to various market dynamics, such as news events, economic data releases, or periods of high volatility. 8. Cost efficiency. Backtesting is a low-cost way to evaluate a strategy compared to the potential cost of learning from mistakes with real money. Overall, backtesting is an essential step for any trader looking to develop a systematic approach, minimize risks, and improve the chances of long-term success in the markets. The 7th rule to avoid losing money as a beginner trader is to avoid using too many indicators. Traders should avoid using too many indicators because it can lead to analysis paralysis, reduce trading effectiveness, and create confusion. Here are some key reasons why keeping indicators to a minimum is beneficial. 1. Analysis paralysis. Overloading charts with multiple indicators can overwhelm traders, making it difficult to interpret signals and make timely decisions. This can cause hesitation, missed opportunities, or conflicting signals that confuse rather than clarify. 2. Indicator redundancy. Many indicators are based on similar data, such as price, volume, or moving averages, which means they often provide redundant information. Using too many can result in seeing the same data in different forms without adding real value to your analysis. 3. Slower decision-making. More indicators mean more variables to consider, which can slow down the decision-making process. In fast-moving markets, delayed actions can lead to missed or poorly timed trades. 4. False signals. A cluttered chart with numerous indicators can generate conflicting or false signals, leading to poor trading decisions. Relying on too many indicators increases the likelihood of being misled. 5. Loss of focus on price action. Price action is the primary driver of market movements, and too many indicators can distract from this critical analysis. Indicators should complement, not overshadow, the direct observation of price behavior. 6. Overcomplication of strategy. A strategy that relies on too many indicators can become overly complex, making it difficult to follow consistently. Simplified strategies tend to be more robust and easier to execute. 7. Increased emotional stress. More indicators can lead to second-guessing and increased emotional stress as traders try to reconcile multiple signals. A simpler approach can reduce stress and improve trading discipline. 8. Poor strategy performance. The more indicators you use, the more likely you are to curve fit or over-optimize your strategy to past data, leading to poor performance in live trading. Focusing on a few well-chosen indicators that complement your trading style and strategy can enhance clarity, speed up decision-making, and improve overall trading performance. And the last, but not least, because it is one of the most important rules, the 8th rule to avoid losing money as a beginner trader is to never trade without a stop-loss. A trader should never trade without a stop-loss because it's a critical risk management tool that helps protect against significant losses and preserves capital. Here's why a stop-loss is essential in trading. 1. Limits losses. A stop-loss automatically exits a trade when the market moves against you, capping potential losses. Without a stop-loss, losses can spiral out of control, wiping out significant portions of your account. 2. Protects capital. Preserving capital is vital for long-term trading success. Stop-losses help ensure that no single trade can cause catastrophic damage to your trading account, allowing you to continue trading and capitalize on future opportunities. 3. Prevents emotional decision-making. Trading without a stop-loss can lead to emotional decision-making, such as holding on to losing positions in the hope that they will recover. This often results in larger losses as emotions override rational analysis. 4. Maintains trading discipline. Using a stop-loss enforces trading discipline by sticking to predefined risk parameters. It ensures that traders respect their risk management rules and avoid impulsive decisions during volatile market conditions. 5. Manages risk-reward ratio. A stop-loss allows traders to set a clear risk-reward ratio for each trade. ensuring that potential rewards justify the risks taken. This helps create a consistent approach to trading and contributes to long-term profitability. 6. Minimizes impact of market surprises. Sudden market movements due to news, economic data, or unexpected events can cause rapid price shifts. A stop loss provides a safety net during such times, preventing trades from turning disastrous. 7. Reduces stress and anxiety. Knowing that your risk is controlled with a stop loss reduces the stress and anxiety associated with trading. It allows traders to focus on executing their strategy without constantly worrying about losing too much on a single trade. 8. Promotes better trade planning. Setting a stop loss forces traders to plan their trades carefully, considering entry and exit points. This structured approach helps in making more informed and calculated trading decisions. Trading without a stop loss is like driving without brakes. It leaves you vulnerable to uncontrollable risks. A well-placed stop loss safeguards your capital and helps you stay in the game for the long haul. And there it is. If you memorize and apply these priceless golden egg rules for beginner traders, I am sure you will have a much easier path than those who do not know and follow all these important rules. And don't forget to smash the like button. It costs nothing, and help us make more great content for you. Thanks for watching. Good luck and good profit. Edward Cash Trader. Please read the disclaimer in the description below. You can support the channel by subscribing and turning on notifications. Let's grow the channel together.